I would almost never start an interview with a Fed official like this, but because yesterday was so confusing, I need to ask you to help us put what the chairman said into context. If you look at the 10-year, the yield was up, it was down, it was sideways, and ultimately it settled lower. The 2-year yield went up, went down, went sideways, ultimately settled a little bit lower. The stock market was up and down. Was it a hawkish message? Was it a dovish message? How did you put in? I know you listen to the chairman almost probably more closely than I do.
I listen to him every day, and it's actually very important. Look, these are complicated times because there are lots of things going in all directions. We have inflation's come down a lot, and I think the momentum is going to continue to be that way. But you see the resilience in the broader economy, which makes it difficult, and that it's a complicated thing. And so in talking about the economy, it's always a challenge because you have these cross currents. Whatever narrative you want to tell, there is some data that's a counter on it. For me, I just try to stay focused on looking ahead, trying to get intelligence about where people are thinking and feeling the economy is going to go. And what I've learned in the 6 years I've been in this job is that when you talk to real people and they tell you real things, it's real. And so I really try to lean into that and take that on board.
And what are they telling you now, and how different is that from the strong data that we've had recently? Strong retail sales, up. Your Atlanta Fed GDP is, practically a skyscraper out there.
It's north of 5, which is high. I understand that. But look, when I talk to businesses, they all tell me the slowdown is coming. They see it. They are seeing their customers start to act in different ways. And they expect that where we are today is a lot stronger than we will be 6 months from now. I've really taken that on board and thinking about what restrictiveness looks like and how it's likely to play out over the next 6 months.
Before I open it up to my esteemed colleagues, I just need to ask you this question. You are the only Fed official, from what I can see, who has used the phrase sufficiently restrictive. Chair Powell yesterday twice got up to there and said, no. He twice said we're still looking for that level. Are you going to be sat at the table all the way at the other end when you get into the next meeting, or are you feeling alone out on a limb? Do you still feel like the Fed is sufficiently restrictive here?
So you'll have to ask everyone else sort of where they are. My seat is set at the table where it is.
Oh, it doesn't change based on your views.
They don't move us around depending on whether they're happy with our view or not. But what I would say is this. I've listened to a number of my other colleagues, and what they have said is very similar to what I'm hearing, which is the businesses are feeling and they're seeing the slowdown. They're anticipating things will contract and constrict from here. And they say a bunch of our policy tightness still hasn't gone through the whole economy. And so I think the trajectory of the economy is likely to go in a way that is very consistent with what my outlook is, which is we are not going to see a recession. That's not in my outlook. We're going to see a slowdown, and inflation will get down to its 2%.
President Bostic, I hear what Chairman Powell said yesterday, and I kind of think, okay, it sounds like he's not really eager to raise rates. It sounds like this has probably bought some time for the committee to decide what they want to do next. Is that the sense you get? Like, it doesn't want to let markets know that maybe they're done, because that would do some pretty lousy things anyway if the market takes that and runs to the bank with it. But at this point, look, we're going to look around. We're data dependent. To me, that says we're just going to see what happens.
Well, I think we're always that way. I mean, so we always want to see what happens. I think the risk is that the market gets ahead of itself and starts to anticipate that we have had an outcome before we've actually had the outcome. And so as I talk about it, I really do try to keep people focused on, look, inflation is still at 3.7%. Our target is 2%. They are not the same, and we have to get a lot closer to the 2% before I would consider any kind of relaxation of our posture. Inflation is job one. We have to get that under control. And there's a risk that if we start to hint, we think we're already there.
We think rates are coming down.
Exactly. And I don't, that's not in my head today. And I don't think that we'll be cutting rates before the middle of next year at the earliest.
It'd be bad if we had high inflation and definitely weaker economic activity. That's just the worst.
Well, high inflation is worse. I mean, you just showed the survey in the previous segment. Inflation bothers people, and that's what we've heard consistently through this period. Even before the pandemic, we had started having conversations and conferences. We asked, inflation or jobs? and everyone said inflation is much worse. So we have got to get that under control. So I think you're
what
exactly
if
right.
what you're doing isn't what gets it under control, and you end up inflation stays high and the economy does slow, and it's not the antidote for the inflation in the first place, and I don't know, it's tough.
Well, it's a risk. We're going to do all we need to and all we can to get inflation under control. I'm actually pretty confident that that's where we're going to go. When I talk to many business leaders, they're telling me their pricing power is much weaker than it used to be, and they are going to be much more sensitive about even trying to raise prices from here because there's a risk that they're going to lose customers.
I mean, I'm convinced you can slow the economy with mortgage rates where they are, and there's just a lot of reasons to think that you will be successful in slowing growth in the economy. I don't know if that necessarily translates to 2% inflation, though, and that's what the bad thing.
I think it will. We'll have to see. Time will tell.
Yeah.
But I'm pretty confident that we can get to our target.
Raphael, by the way, the Beige Book, which is the collection of anecdotes, was much more downbeat or stable or neutral than any of the economic data we've had, which is an interesting thing. Do you think the neutral rate is ultimately higher? Is the long-run rate for the Fed funds, is it a higher rate than it had been in the past?
I don't know. I mean, it very possibly could be, and this is going to be something that we're going to talk about a lot over the next 5 years or so as we start to rethink all of our framework. So, we're starting to do our framework review on a much more regular basis, and that time is coming up. There have been a lot of changes in the economy. If you think about the pandemic alone, how people are working has changed, how people have retired has changed, and how people want to live their lives has changed. I've talked to a number of families where they had two earner families, and then they started doing the math during the pandemic and said, look, one of these earnings is just to cover commuting costs and maybe a night out.
And
maybe
daycare.
we want to just keep one of you home.
Yeah, daycare, too.
Exactly right. And so there's a lot of those structural things that are happening. Those things we'll have to really evaluate.
So I'm interested in how you're operating relative to that idea, which is, when do you see the Fed might reduce rates?
So when we get really close to 2%,
Right, but if you had to give us a date or a time.
So I would say late 2024.
Okay, all right, so stick with that. Late 2024, you're going to keep rates, your best outlook. I understand it's just a forecast. And yet in that same forecast, I'm guessing inflation comes down. So that means you are forecasting a higher real rate, at least for the next year, than otherwise, which sort of tells me you're operating under maybe that neutral rate is higher.
That's possible. Look, today there's still a lot of momentum in the economy, right? Which means my outlook says that inflation is going to come down, but it's not going to fall off a cliff. It's going to be a slow kind of steady is probably not the right word, but it'll be sort of a progression to 2 that's going to take some time. And so we're going to have to be cautious. We're going to have to be patient. But we're going to have to be resolute. We're not, and to me, I've really tried very hard to not let any individual data point drive or cause me to change or adjust too rapidly. Because I think what we're going to see is the data is going to bounce around. And so it's going to be sort of a longer term trend. That's the thing I've got to focus on. If inflation expectations take off over the long term, that's going to be a problem. We're going to have to respond to that. If inflation reverses itself and starts to rise, we're going to have to address that. So I'm not locked into anything, but I think the long-term trend is actually moving in a very positive way.
Steve's made the point, we've talked about how you are probably closer to this than any other FOMC member, just in terms of saying, okay, maybe we're done. That's how we've painted it. I don't know if you see it the same way. Do your colleagues feel similarly? And I ask because you're not a voting member this time around. Are those sentiments things that you feel like your colleagues are kind of on the same board with, or is that an uphill battle to convince them of the same?
So I don't think about it like a battle. I think part of this is different presidents and different governors. They have different information sets, and so we're all seeing different parts of the economy. And what our conversations are really about is how we are all collectively seeing them. Mm-hmm. What I would say is the data has come in over the last several months consistent with what I've expected, and the inflation has started to move down, and that's informing how everyone is viewing the world. And we'll just continue to see that process. And I think you've heard this from my colleagues as they've been going around, much more open to just saying, look, things are moving in the way that is consistent with getting to our target. Let's
What if the 10-year is totally unmoored? And I'm wondering if you have how high could it go with no more Fed action? How high could the 10-year go, given that people have to feel like they're getting paid to stay somewhere for 10 years? I mean, I wouldn't do it for 5%, I don't think, because I'm worried that I want a lot more. So could we go to 5.5% or 6% with the Fed totally out of without raising?
So, that's a good question. I actually don't think about that very much.
That could ruin everything.
No, I understand that. But what that will then translate to are things in the real economy. And so what I try to do, I talk to my business leaders, I talk to families, and I want to know how these rates are affecting their decisions today and how they expect they will affect them tomorrow. And what we've heard so far is that many businesses are still flush with cash. And so the real world effect is going to be muted relative to what it would be otherwise. And so that's the way I'm thinking about this, to try to understand what the impact is likely to be on the things that are our metric.
But I just want to point out, you're a voting member next year, right?
Yeah,
in a couple
I
of
start in
months.
January.
Yeah.
Yes.
So
how worried are you about the corporate refinance that's coming down? Because right now people have been immune to it, or the companies have been, but they're going to have to, at some point, refinance that debt.
Yeah, we talk about that a lot in our building. It's something that we are definitely keeping an eye on, and it is true that many of the corporations that took out debt, they refinanced 2020 and 2021. So that's coming due now. Over the next several years, I think in the next year and a half even, there's trillions of dollars that is going to be refinanced. That is going to have an effect. So this is, I said earlier, there's still some slowdown that's coming because of our policies. This is one of the dimensions where that's happening.
In the building you just said you're in might have to refinance too at a Harvard, but
I think they own it, Joe.
Oh, that's right. So you're lucky. I mean, the good thing is that the bond market can do some of the work for the Fed, but if you're totally not controlling it, you're not controlling it, and it may do way too much work for you.
Well, I don't think that we actually control the bond market. Like, there are other factors that drive its dynamic. We've got to do what we need to do.
Are the vigilantes back? They kind of are, Raphael, aren't they? They're like looking around. They're not buying. They're not buying what we're selling right now.
Yeah, I don't know about the vigilantes, but I will say this.
Does the government have to get its act together? Is the deficit unsustainable?
The deficit will become more of an issue as debt service increases, and that's coming. I expect that the Congress will and the President will start having conversations on this pretty aggressively.
I think you ought to give your vote to somebody else. Say, I don't want to be responsible for this. I don't. This is not my. I want to watch. Can you do that?
No.
President Bostic, thank you very much for joining us today. We appreciate it.
Thank you.
Steve, thank you.
Right, coming up, spot Bitcoin ETF excitement is around. You can almost feel it. It's building, it says here. And